So welcome everyone to this webinar, 5 Expat Tax Tips for UK Property Owners. So I'm running this with my company Property Venture alongside Churchill Tax Advisors, and we've got Hazel and Dave here from Churchill Tax Advisors.
Hello, I'm Hazel. I have 30 years experience of giving tax advice to high net worth individuals and lots of cross-border advice. So people either coming to the UK, leaving the UK, property investment, offshore trusts, a whole range of structuring for people who wish to invest in this country. I originally trained as a barrister and I'm still a lawyer rather than an accountant.
Thank you, Louise, and good afternoon, everybody. I have, similar to Hazel, over 30 years tax experience, but nearly 20 years of my experience was spent with HMRC Inland Revenue. I'm an ex-inspector of taxes, so my responsibility within the revenue as a senior inspector was to investigate high net worths, individuals, multinational companies and the like. I have then spent the last 14 years working with top 10 accountancy practices based in north of England and London. I've assisted clients facing investigations by HMRC for residence domicile, non-resident landlords, UK and overseas trusts, inheritance tax enquiries, property developers and the like, including taking appeals through the tax tribunals up to the Court of Appeal alongside QC counsel barristers as necessary. I've also provided expert witnesses in criminal tax evasion. So I use my experience and skills of knowledge, both sides of the fence with the revenue, to tackle and deal with problems that people may have with HMRC.
Okay, that's great. Thanks very much, Hazel and Dave. And what we're going to do is we've got 5 broad topic areas that we're going to cover, have a discussion and question and answer session with Hazel and Dave, which will cover quite a lot of ground, and then we'll turn to the questions that you might have on Dave as well. So if we kick off, I mean, in my business, I have lots of conversations with expats, and there's always a perennial issue about setting things up in the right way tax-wise. And as we all know, the buy-to-let market in the UK has changed significantly over the last few years, with all of the mortgage interest tax relief having been withdrawn, with stamp duty surcharge, just to name a couple of the areas where changes have been made. So it's much more about planning ahead and thinking through how to set things up. So Hazel, if we can start with you, one of the big things that I find myself having a discussion with expat investors about is how to set yourself up, whether it's buying personally in residential property, buy-to-let property, or whether it's going down an SPV, special purpose vehicle route, which may either be limited company or LLP partnership route. Could you give us some thoughts about rule of thumb? I know that everybody needs to have tailored advice given to them, but just some general rules and principles that you can share with us about the differences and the upsides and downsides of personal versus SPV investing.
I think, I mean, the first factor that really has to be borne in mind is how you're going to finance the acquisition of your property. Because if you've got a lot of borrowing, if you're anticipating a lot of commercial third-party borrowing, then investing through a company is going to become the best, probably the best choice for you, because of the restrictions on mortgage interest deduction. And if, depending on how heavily geared you are, you can end up paying tax on an income, a nominal income, for tax purposes, which is higher than your actual income for your actual net income, your receipts, so that you can find yourself not actually making a profit on your rentals, because you're having to pay away effectively 110% of your rental income in tax and mortgage borrowings combined. So at that point it all becomes very uneconomic. So securing a deduction for interest is vital, And of course, you will be paying the 19% corporation tax rate on your rental income. However, there is a price that you pay on the other side of that transaction, because you'll be paying more in stamp duty land tax on the acquisition. And it's not clear, although the Chancellor has announced a SDLT holiday until next year on purchases up to 500,000.
It was an interesting development, wasn't it?
It was. It's, again, with all these things, you may get a headline announcement, but what is actually going to happen and how that's going to apply to people who are making commercial investments as opposed to people buying a house to live in, we're going to have to wait and see what the details are on that to see how it's going to affect people. I mean, I think one thing to bear in mind when it comes to considering the impact of stamp duty land tax is, of course, that depends on how expensive a property you're buying. If you buy lots of small, relatively low value rental properties in the less fashionable parts of the UK, SDLT isn't going to bear down on you, and you are going to be more concerned about the rental income. If you're buying one big property in central London and you're not financing it through borrowing, but you are already in funds, then it may be that holding personally is better for you, because the SDLT hit is going to outweigh any other potential tax savings. So it is always, I think, a very bespoke question that depends on how much borrowing you're taking on board and what sort of value rental properties we're talking about. And of course, in the case of non-residential property, the commercial or mixed rates of SDLT are much, much lower. So at that point, again, you have a whole different set of things to consider.
Okay, so if expats are investing, and I know that there are a number of expats who do invest in the Midlands and up north for yields and for entry-level pricing, then they're not going to benefit if the stamp duty, Rishi Sunak's stamp duty holiday up to £500,000. We don't even know yet whether it's homeowners only. We need to read the small print, or whether it is for investors as well.
Yep.
So that might not affect those as much, but if expats are looking to invest in the southeast, then it may well affect. But also the other thing, what you're saying is that it's the level of borrowing and the value of the property, which will also help determine whether you invest personally or via a company structure of some description.
Yes, because I think there is essentially a tension between your mortgage interest deduction,
yes,
being fully allowed as opposed to sort of being partially limited, and the extra SDLT costs. So you will always have to look at the numbers to see which tax you're paying more of and how it affects your decision. And it may be that the balance swings one way or another. I think one thing also to bear in mind is that in the good old days, it used to be if you were non-resident, you could sell UK property free of capital gains tax, which is no longer the case. But it's also no longer the case if you hold the property indirectly through a company. So that doesn't factor into your decision as to whether to hold personally or through a company, whereas it may have done sort of 2 or 3 years ago. Okay.
And then as a general rule of thumb, I hear what you're saying about the value of the property, and it's not just a number, but so if someone's just starting out and they've just got 1 or 2 investment properties versus a portfolio landlord who's got 4+ properties, is there a general rule of thumb that if you're starting out, it still might be advantageous to consider personal investing versus if you're then looking at building up more of a portfolio and you're getting closer to 4 or 5+ properties?
I think, again, it sort of depends what your ultimate plans are, because if you decide to invest personally, it becomes very difficult to then put the property into a company. And if you then turn into a portfolio borrower, you've lost your opportunity. So I'd say that, very broadly, there would be always a slight preference to holding through a company. But of course, it's always possible to have a mixed approach. So you could hold some properties through a company, you could have one or two held personally, because you've also got to think about how you're going to extract profits from that structure. And if you take dividends or you take salary, then there's additional tax to face then. Whereas if you're just receiving rental income passively from a property, you just pay tax on the rental income, you don't pay tax on the rental income, and then again when you extract funds from the property. So it is always very much a question of looking at how you want to run your business. If you're looking to roll up rather than draw down, a company is probably the better choice. If you're looking to draw profits, then maybe holding personally might be an option. Maybe it's a mixture of both, depending on providing an income from a couple of properties and then having your property portfolio elsewhere. And also, if you're going to sort of get into property development, I mean, I certainly think if that's your choice of doing business rather than just buy to hold, then you'd want to be looking at sort of corporate structuring.
Okay. And are there some simple things, if expats out there own one or two properties and they're married, that they can be doing about sharing that or apportioning that between two spouses, like the becoming tenants in common rather than joint tenants, and using sort of declaration of beneficial interests? Might that be something worth considering?
That's certainly something that you can consider. I mean, you can no longer, I would say very broadly, shift income between spouses easily unless you have made the appropriate declarations about the capital holding underneath it. It used to be you could just sort of say, well, we own the property 50-50, but we elect to be taxed 90-10, and you can no longer really do that. But also at that point, you might want to think about a partnership structure.
Okay.
And then you could play, you could do that kind of income split of 90-10. But again, that's only something you really want to be thinking about if you have a lot of properties and you want to, because otherwise, the costs of running the structure are prohibitive compared to the amount of tax savings that you could make. Otherwise, yes, it is just simply a question of declaring how you're holding the property from the outset, or adjusting that holding later on.
Okay, and just LLP versus limited company, just sort of upsides, downsides, because some people invest and transition through LLP into limited companies, don't they? They don't always just stay in that one structure.
No, and that's certainly a possibility. I mean, the thing about the LLP is you're not going to have you'll still have your interest restrictions, but you won't have the additional SDLT, and you can then use it to build up your portfolio. And there are ways of then turning your LLP into, or sort of incorporating it in a way that's reasonably tax-free. You would get taxed. I mean, LLP is a look-through, so you get taxed on the whole of the rental income. You wouldn't have the opportunity, particularly, to roll up tax-free. You're not obliged to take the funds out of the LLP, but you are taxed as if you have done so. So you can leave the property, then the net proceeds in, and roll those up and reinvest. So, they do have their place. Perhaps as a sort of an intermediate stage before becoming a proper full portfolio landlord.
Okay. Dave, is there anything that you want to add to that before we go on to the next area? Anything on the limited company, SPV structure versus investing personally?
Obviously, if people are buying new property, then they have to look at the whole picture, and it's not just a question of the tax situation. You also have to look at the ability to borrow and the mortgages that are going to be available to a corporate vehicle. Certainly most brokers will now have a much bigger portfolio of lenders who are willing to lend to corporate bodies than they previously used to be. There's obviously been a number of mortgages that have been taken off the market during COVID. And no doubt if maybe landlords have taken, for instance, any mortgage holidays, that may affect their ability to borrow further. They'll look at that. It doesn't affect your credit rating, but it may well affect the ability to borrow new money if you're looking to invest again. So that's something to consider. The mortgage holidays are still available until October, but people need to seriously look at whether that is absolutely necessary, weighed up against the effect it could have on a potential lender who looks and asks those questions. Did you take a holiday or not? That could have a bearing on that. And that's obviously both for corporate and potentially for private borrowing with investments and properties.
Yeah, we're living through very strange times at the minute, where normal rules seem to be up in the air. Just hearing lots of stories of valuations, you know, bridging loans, all sorts of things that a lot of lenders don't seem to be playing by the rule books or what you'd be normally expecting. So let's hope that settles down pretty soon.